In 2001, I broke the news to many of you that investors underperform the very investments that the investor invests in. Try to say that 5 times fast. But yes, it's true that the investments we actually invest in, the S&P 500, large cap, small cap, whatever it is, that these investment funds perform better. They outperform the very investors who are invested in them. That was the first episode of the whole podcast. The foundational episode was on this little known fact to most people, that there's a huge difference between the returns of the average investor and the returns of the actual investments. Well, all that was from old data, and so we looked at the new data just recently to find out that it's still the same, that investments still outperform investors. And that'll come to no shock to any of you who've listened to this for a while, but I always think it's good to review and have the latest information, the latest data, and to see that these things continue to happen and know where we should be focusing our attention. So again, way back in episode 1, we looked at this foundational concept that the difference between investor and investment returns. And we looked at data from the 2020 qualitative analysis of investor behavior. It's put out by a firm called Dalbar. They do it every single year, update the latest version of it. And so that one had data up through December 31st of 2019. And so they do all this comprehensive tracking and then put out this big report. And what it does is it tracks not just investment returns, but actual investor returns. They can measure all these different things of inflows and outflows. And I'm not sure exactly how they do the math. It's some pretty heavy nerd math. But they can figure out, hey, what is the actual returns of the average investor? And right, and then that data was quite telling in that it revealed this massive difference between the returns of the investments we track versus the returns of the investments that we earn as investors. And a lot has happened since 2019, right? There's been a global pandemic that rocked the world economy and society. Wars have broken out. Inflation hit a 40-year high. The Fed raised interest rates faster than they ever have at any point in history, causing bond prices to plummet. And through all this, right, have investors done better or worse than their investments? I think you probably know the answer, but, we should update it anyway. The QIAB report, this report is nearly $2,000, so I don't like to buy it every year, but it is time to get an update that encompasses all this latest information, all these latest events that have happened. And so with the 2022-2023 bear market all but recovered since then, the last 30 years, kind of having a nice rounded out number there, it feels like a good time to revisit these things. So the first realization from this new report, right, is that investments still outperform investors by 1 to 5% per year. Across all rolling time periods, investments do better, right? So if you take a look, right, we'll display this on the screen for the YouTube audience. It is in the blog post for this blog, so you can go to this episode 167. So you can go to retirementmentorship.com/167. You can see it there. But for the podcast audience who's just listening, I'll just read off a couple of high points, right? So over 30 years, the S&P 500 has averaged about 10%, and the average investor has averaged about 8%, right? Over 10 years, 12 for the S&P 500, 8.5 for the average investor. Over the last 3 years, the S&P 500 did 10, right on the nose, 10%, and the average investor did 4.22. So the S&P 500 is doing far better than the investors who are trying to do this. And again, these are equity investors. We're not talking about people who have a bunch of their money in bonds or have a bunch of their money in CDs. It actually tracks that separately. These are just people who are all in equities. And so this is not a difference in returns because of their bond allocation or their REITs or their gold. This is, hey, they're investing in the same types of funds, and these are the performance that they're seeing. And we have not done well in the short term, right? We have underperformed the S&P 500 by 3 to 5% per year, and that gap slightens or it goes down a little bit as you go further out. But the problem is that the longer you go, the greater the impact there is on the actual dollar amounts themselves, right? Because we don't really understand percentages. We can look at that. We can see a 2, 3, 4, 5% gap between investor and investor returns over all these different time periods. But what does it actually mean to us as humans who want real money, not just percentages? Well, here's the deal then, right? Investments outperform investors by thousands, if not tens of thousands of dollars. So if you took $10,000 and invested in the S&P 500, the Vanguard S&P 500 fund, right? Not just an index, but the actual fund itself that you can actually invest in back at the beginning of each of these periods, and you took that versus the returns of the average investor, you would get this new table, which we'll post. It's on the blog. We'll post it up on the screen for the YouTube audience here. But you can see that, right? That the difference between 8% and 10% over 30 years means the average investor would have taken that $10,000 over 30 years and turned it into $86,000. That's pretty good, right? That's an 8x return. But the S&P 500 would have taken that same $10,000 and turned it into $176,000. That's a 17x return over that time. That's a massive difference. You're out $90,000 as the average equity investor versus just investing in a Vanguard index fund. $90,000. And again, I would point out that that's $90,000 per $10,000 you had invested originally, which means that if you had $100,000 or $120,000 invested for 30 years, you're missing out on $1 million plus over just investing in a simple, right? Stupid, some people call it, Vanguard S&P 500 index fund. And so again, you can look at, I'm not going to go through the whole table for the audio audience. You can see this on the YouTube. You can see it on the blog post, retirementmentorship.com/167. But across all time periods, you're looking at thousands and tens of thousands of dollars of losses by being an investor versus being the fund itself. Right? The longer you stay invested, the more you lose. As James Clear, the author of Atomic Habits, as he says, right, time magnifies the margin between success and failure. And so the longer you continue to get subpar returns, how you continue to underperform the investments that the investor invests in, the more you have to lose, right? So why does this happen, right? Why do investments outperform investors? And part of it is that because investments don't make mistakes, right? Index funds don't make mistakes. They just track an index. They don't make behavioral mistakes. They don't buy and sell. They don't do all these things. They just perform. Sometimes good, sometimes bad, over time, always good, right? And so these gaps in performance are entirely caused by our behavior. That's why Carl Richards put it so aptly named it the behavior gap in his eponymous book. That we have repeated, and in this podcast, we've repeatedly looked at the 4 horsemen, which are the main behavioral mistakes that we make that lead us to this gap. But there are other reasons for these gaps. And so over the next few weeks on this podcast, we're going to look at the rest of the quantitative analysis of investor behavior and many of its implications for us as investors. Right? And my goal is to make you a better investor, to close that gap between your returns and your investments' returns, and ultimately to earn you thousands of dollars more in real results. I think that is worth taking a few weeks to pay attention to. So we'll continue this conversation next week on the podcast. Have a great week. We'll see you then. Cheers. If you enjoyed that, you would love being part of our free membership community. It's called Retire Membership and is a host of benefits all for free. For example, you can always buy my book, 3D Retirement Income, on Amazon. But if you join us at Retire Membership, we will send you either a hard copy or paperback for free, provide the ebook and the audiobook so that you can listen to it if you don't have time to read it. In addition to that, we'll also provide you with a bunch of content that you can't get anywhere else. For example, we have our quarterly Retire Mentorship magazine, which comes out quarterly and has no ads whatsoever. It's just timely content to help you stay the course. We also have workbooks for our free online workshop to help you get the most out of those, flowcharts to help you make better decisions, and a weekly email to provide timely content that you can unsubscribe from at any time. We never ask for any payment information, and we never share your information with anyone else. We just want to provide timely content and help you stay the course to retire successfully and stay successfully retired. There's no reason to wait, so join us now at retiremembership.com, where you can click in the link in the description and it'll go right there. We can't wait to see you in the community. Cheers.